podcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody, and welcome to this webinar titled Tax Efficient Business Succession Planning. My name is Alex Nicholson. I'm a tax partner here at James Cooper Creston, and I'll be presenting the webinar today. Scheduled time is for 45 minutes, I think, hopefully in your calendars. I'm not quite sure whether we'll need all of that time or not, but we'll see how we go. So moving swiftly on then to the contents that we're looking to cover today. Well, I think the first point I wanted to make really is that succession planning is a really, really large topic. And there's no possibility of me sort of covering everything that might be relevant to everybody today. But I'm going to do my best to sort of cover a lot of the issues that we see within our client base. So some of the topics then that we're going to look at, I'm going to focus a little bit initially on entrepreneurs relief, because very often succession planning is about the owner-manager of a business extracting value from that business for their personal sort of retirement plans, etc. We'll look a little bit at deferred and contingent consideration and what impact that can have on entrepreneurs relief. We're going to discuss management buyouts, spend a fair bit of time focusing on family businesses, because many successions that we see at least do involve family businesses, and they have some sort of unique considerations. We'll also briefly look at CGT free disposals to an employee ownership trust, which is a relatively new sort of regime, a very generous tax regime that was introduced a number of years ago, and is attractive to some, but in practice it's not something we see all that much of. We'll also consider cessation and an orderly winding up. If you do have any specific questions, I think you have a question facility on your desktops. Please feel free to raise them, and if I get time at the end, I'll pick up on some of those questions. So kicking off then, I just wanted to ask you a couple of questions to try and understand a bit more about who's listening and what their needs are. So the first question I wanted to ask you, please, is do your business succession plans centre on any of the following? I'm, of course, assuming that you're listening to this webinar because succession is important to you. So the options are a sale to a third party, family succession, a management buyout, cessation and an orderly winding up, or anything else really, or you know, all viable options are on the table. So if you could please give me your answers now, that would be great. Just wait a few seconds for those answers to come in. I think it looks like we've got nearly all the votes now, and we seem to be about 23% of listeners are considering a sale to a third party. We have almost 50% of you looking at succession within the family, a smaller number looking at cessation and orderly winding up, and another sort of quarter roughly undecided at this point in time. So the second question is, what is the timescale for your business succession needs? So I've just broken down that into three categories there. Is it imminent, less than 1 year, 2 or 3 years, or more than 3 years? So if I could please just gather your responses to that, that would be great. Just wait a few more seconds, just a couple more to come in. So it looks like approaching half of you, it's more than 3 years away. Not too many are saying it's imminent, but we've got about 15% saying it's imminent, with close to 40% then, or around 40%, sorry, saying 2 to 3 years. And I mean, that's quite reassuring for me to hear that most people who are listening to this webinar today are actually thinking about it well ahead, because one of the key points I want to try to convey really is the importance of planning ahead. So getting into the detail then. So this first slide on entrepreneurs relief really is just trying to give a refresher on the key conditions. As I've said, you know, very often business succession is about the current owners extracting value, and they will very often have an expectation that any gain that they make on a disposal is going to qualify for the magic 10% tax rate that applies with the benefit of entrepreneurs relief. The important point to appreciate is that not all businesses will qualify, and there's a number of pitfalls to be avoided. But again, with advanced planning, it's often possible, sorry, not impossible. It's often very possible to improve the entrepreneur's relief position. The current CGT rate, absent of entrepreneur's relief, is also attractive. So it's currently 20%, which compares very favourably with the maximum rate of income tax, which is currently 45%. So even if entrepreneur's relief isn't available, still getting within the capital gains tax regime rather than the income tax regime is attractive. Every individual has a £10 million lifetime limit on gains for which entrepreneur's relief can be claimed. And it's important to make the point that it is for qualifying businesses only. Broadly, that means trading businesses, not investment businesses. So for example, if you have a property development business, that should potentially qualify for entrepreneur's relief. If you have a property investment business, it won't. Very often where we're looking at the sale of a sole trade or a partnership interest, as opposed to a sale of shares in a company, which we'll come on to, entrepreneur's relief is relatively straightforward. Broadly, where the whole or part of a business is sold, it's capable of qualifying if it's a trading business. Where it's only a part that's sold, though, it does need to be capable of being carried on in its own right. There is a 2-year ownership period, and that applies for shares in a company as well as interest in a sole trade or partnership. And so for companies, the rules are slightly different. I mean, at the date of a disposal, the disposing shareholder must be an employee or director of that company, and they must have at least a 5% ownership in that company. There were some quite significant changes to how that's tested last November, but if you have a 5% economic ownership, then you should be all right. And for companies, they have to be wholly or mainly trading. And that basically means that the trading aspects need to be more than 80%. I'm not going to go into more detail on that here because it would take a little while to explain all the subtleties around that. And as I've mentioned already, it's a 2-year qualifying holding period minimum now for entrepreneur's relief, which applies from the 6th of April this year. Prior to that date, it was just 1 year. There's also with companies some considerations as to whether a company sells its shares or whether it sells its assets, and we'll come on to look at that later on. So deferred and contingent consideration, and I'm considering this really in the context primarily of entrepreneur's relief, but also just capital gains tax generally. I think most people will be comfortable with the concept that if they sell their business and they get cash up front, then capital gains tax is payable, and that's due the 31st of January in the following tax year, i.e. the tax year after the disposal. So for example, if there's a disposal in the current tax year, 1920, then the capital gains tax due will be payable on the 31st of January 2021. In practice, though, it's quite rare for businesses to be disposed of for 100% cash up front. And what we see more typically is that there may be some cash up front, and then there'll be an element that's deferred. Sometimes at the outset, that deferred consideration will be fully ascertainable, and where that's the case, the ascertainable but deferred consideration is also taxable in the year of disposal. And one of the things that you need to think about there is actually whether there's sufficient upfront cash available to meet the taxes. Whether deferred consideration is payable but is ascertainable but is payable over a longer period, and that period exceeds 18 months, there is the potential to pay the tax in instalments. Unascertainable consideration is where it gets a little bit more interesting. And the classic example of this, of course, is an earn-out, which is dependent upon the future results of the business. Many sellers incorrectly assume that unascertainable consideration will mean, where there's an earn-out or something of that nature, they incorrectly assume that they'll qualify for entrepreneur's relief on the later sort of cash proceeds as a result of that earn-out. And this is probably best illustrated by an example, which is on the next slide. So here we're assuming that we've got a sale of shares in 2018-19. I'm making the assumption it qualifies for entrepreneur's relief. The consideration up front is £2 million in cash, plus an earnout which is based on a percentage of the future results. At the time of that disposal in 1819, a valuation exercise needs to be carried out to value that right to future consideration. And we're making the assumption here that that's valued at £250,000. The tax position on this then is that in 2018-19, the seller is taxed on a gain of 2.25 million. With the benefit of entrepreneurs relief, the capital gains tax liability on that is 225,000 maximum, i.e. the 10%. In reality, of course, it could be a bit lower if the seller has got base costs that they can set against their disposal. So rolling forward then, if we assume that that earnout pays £400,000 in 2019-20, then we have a further gain of £150,000. But that gain does not qualify for entrepreneurs relief. It's treated as a separate asset, and therefore we're going to get capital gains tax on that at 20%. So a further £30,000 worth of capital gains tax becomes payable. That covers largely all I wanted to say about deferred and contingent consideration, except for picking up really on loan notes. Very often, where it may be that the amount is quantified up front, but consideration is deferred in the form of loan notes. And there's two different types of loan notes that exist, qualifying corporate bonds and non-qualifying corporate bonds. And actually these have a different tax treatment. And it's important to work through all of that, which I'm not going to do here today. But the point to take away really is that if there are loan notes, you need to understand the tax consequences that come with those and the impact that it can have on your entrepreneurs relief position. Sometimes it will be beneficial to sort of elect out of a sort of rollover of gain into the loan notes to pay tax up front with the benefit of entrepreneurs relief. Sometimes that may not be necessary. A final couple of points on this then. Ascertainable but deferred and contingent consideration can sometimes be attractive. And the reason for this is that unlike an earnout, there's no valuation exercise to do. Everything's known up front, albeit that it's contingent upon future events. And in the circumstances that some of the consideration does become irrecoverable, under any of these scenarios, really, if you find that you've overpaid tax on the upfront gain, then there are mechanisms within the tax legislation basically to make a claim and go back and reclaim any overpaid tax. So that concludes deferred and contingent consideration. Moving on now to management buyouts. This is a very common succession and exit plan. There's a great many variations within it, but a few points really before looking at a typical structure. I mean, one of the main points to take away is that actually the vendor can have a continued involvement and may even retain some shares in the company, in the business. There are some caveats about this. Very often tax clearances, well, nearly always tax clearances will be recommended for this type of transaction, and the level of the retained sort of shares will typically need to be fairly modest. Certainly the selling shareholder will need to give up control, because if there's insufficient sort of equity given away, then there's a risk that the revenue can seek to invoke certain anti-avoidance legislation known as transactions in securities, and to tax some of the disposal proceeds to income tax rather than capital gains tax. So as I said, there's many variations that we do see in practice, but a typical structure looks something like that indicated on the slide here. So essentially we have a target company. We've established a group of management, whether they're existing employees within the target company or whether we're doing a management buy-in. And those management shareholders who are going to become the owners will form a new holding company. That new holding company acquires the target company from the vendor, and the vendor will typically then take their consideration in a mixture of cash. It could be some shares, as I've said, in the holding company, because there's this possibility to continue to be a shareholder, and indeed loan notes, which of course we've just talked about. Of course, the hold company is normally set up in such a way that we achieve the desired sort of ownership of the ongoing business, as has been agreed between the parties. So that's the typical structure. And then the next sort of consideration is, well, how do we fund it? So if you're the management buyout team, how is this going to work? How are you going to make this happen? So in forming the new holding company, management will of course subscribe for shares, and they may pay valuable consideration for those shares, or they may make loans to the holding company. So sometimes, very often, that forms a fairly small part of the upfront consideration that we see. It may be possible to leverage the target company, to use it as security for essentially bank borrowing, and then to use dividends from the target to fund repayments on that. Frequently, we see that there's a fair amount of cash that's been retained or built up in the target company. And actually, it's that cash which forms a lot of the upfront consideration that's payable in cash, with further consideration then being paid in the form of loan notes. So essentially, where there is a significant amount of cash and retained profits in the target company, that can be paid up to our holding company and then paid out to the vendor as part of the consideration. There are some tax traps that need to be avoided there. One is the loans to participators, which can see a nasty corporation tax charge if you don't deal with the intercompany loan that exists between the holding company and the target as a result of that cash moving. It can normally be cleared by way of a dividend, but if that's not possible, other strategies need to be explored. Management buyouts are also often private equity backed, so you might have the private equity house taking a stake in the business alongside management. It may be that the private equity house is taking a majority stake. The principle behind those types of structures is still, broadly, as I've summarised, where you'll end up with an acquiring company buying the target, although very often the structures are more complex and will involve a number of new corporate entities, depending upon how debt finance is being structured into the transaction. The other thing, of course, is just to perhaps mention loan notes again, because, of course, what they do allow is for future profits of the business, the target, to be used to buy out the seller. Other things that we sometimes factor into our management buyouts might be enterprise investment scheme tax reliefs, or indeed the even more generous seed enterprise investment scheme reliefs for the acquiring management. It won't be possible in all cases, but if you've got a business that's less than 7 years old, and the management shareholders includes, basically none of them can own more than 30% of the business to qualify for all the tax reliefs. But let's say you've got 4 shareholders who are management shareholders who are acquiring the business, EIS reliefs may well be available and can be extremely generous. It's also necessary to be mindful of the employment-related securities legislation. Basically, this kicks in where employees acquire shares at an undervalue and can subject that undervalue to income tax. Generally, it's more of a theoretical risk as long as everything is worked through properly, but there's certain elections, typically a Section 431 election, that should be made in connection with most management buyouts to ensure that for the management team, when they do eventually come to sell their investment in the shares further down the line, the whole of that falls within the capital gains tax regime, and some of it isn't charged to income tax under the employment-related securities legislation. As I mentioned previously, this type of transaction, the management buyout, it's nearly always recommended to get HMRC tax clearances. This just confirms that the revenue will not invoke certain pieces of anti-avoidance legislation, such as those which I've already talked about previously, transactions in securities, which again can see some of the proceeds that are being paid out to the vendor subject to income tax and not capital gains tax. The final point on this slide then is just to mention that where the management are having to borrow personally to invest in a management buyout, to invest in shares, then income tax relief is normally available for that borrowing, provided they have a material interest in the company, which is 5% or more. and broadly that they're working in the business on a fairly full-time sort of basis. This leads me into family businesses now. Obviously, when it comes to family businesses, there's a whole range of practical family issues that will need to be considered. If there's a number of children, adult children that are involved in the business, which one's going to be the successor, and how do you achieve equality between different family members? That's outside the scope of what I'm going to talk about today, but inevitably forms a large part of any exercise for family business succession planning. The way we would go about approaching succession for family businesses is to address a number of issues really in the following order. And I'm going to just talk through a bit of this at a sort of high level, and then move on to a couple of case studies where hopefully some of that will come to life a little bit more. So the first issue to address is the pros and cons of lifetime gifts of the business assets. So typically in a family succession situation, you've got mum and dad that are kind of looking to retire and hand the business over to the next generation. Now the question is, do they actually hold on to their ownership of that business until they die? And the main reason for doing that is that if a business qualifies, the main reason for holding on to the business until death is often that you get a CGT uplift in the base cost of the assets if they're held at the date of death. If the business qualifies for business property relief from inheritance tax, then there's also no IHT that's payable on death. So essentially, you can then transfer ownership with no tax liabilities happening on death, and the children that are inheriting the business inherit it at its current market value, such that if they then dispose of it at a later time, they'll have an increased base cost compared to that which their parents had. There's various strategies then that can be invoked under wills to deal with assets being retained until death and then passed on. So the other alternative, of course, is to make a lifetime gift. And there's lots of considerations that come into this. And one of the reasons why a lifetime gift will often be attractive is, of course, because it gives the successor earlier ownership and control of that business. But also there could be a perceived risk that perhaps business property relief from inheritance tax won't be available at the date of death, or it won't be as generous as it currently is, where many businesses will qualify for 100% relief from inheritance tax. And therefore that can drive a desire to do something now rather than to wait until later. One of the important things where there are lifetime gifts is to be aware that business property relief can be clawed back if there's a lifetime gift of a business asset and the person who makes that gift were to die within 7 years of the date of making the gift. If the asset's still owned at that time, if there is a death within 7 years and the asset's still owned at that time and qualifies for business property relief, then there's no issues. But of course, if the nature of the trade may have changed, then that can give rise to a loss of business property relief. And in those circumstances, it's quite often possible to insure against those risks within IHT inheritance tax insurance. The regime, however, is a bit more generous for shares. So where shares are being transferred, if they qualify at the time of the gift for business property relief, then provided those shares are still owned at the date of death, if that's within 7 years, then even if the nature of the business has changed, there isn't actually a clawback of business property relief. Where business property relief isn't available, then there's other things that sort of come into play. So one of the main factors in making lifetime gifts is where there's a disposal from parent to children, and all my references, by the way, to children are to adult children. Where there's a disposal from adult to children, it's deemed to take place at market value. So obviously it's a gift, but it's deemed to take place at market value for tax purposes. Now, where it's a trading business, ordinarily it's possible to hold over any gain that arises on that gift. But if it's a non-trading business, then that holdover relief is not there in the same way. And this is where sometimes a gift into trust can be advantageous, because a gift into most trusts is potentially subject to inheritance tax. And because it's potentially subject to inheritance tax, whether or not business property relief is available, there's an ability then to hold over any capital gains tax that arises. As I've said, there's specific problems in relation to gifts of investment businesses, some of which I've just touched on, but I'll try and now bring it to life a little bit more with my case studies. So case study one, these are real life case studies of things that case study two is one that I'm currently working on. Case study one was a couple of years ago. We had a simple trading company. It's a market research business, and the shareholdings in that essentially had been set up by it had two main shareholders. They were unconnected with one another. One of them had his son working in the business, who was significantly involved in the business and ready to take on a management and ownership role. The other main shareholder had no family in the business, but they had identified another individual who they also wanted to pass ownership to. So we've got a mixed situation here where we've effectively got part family business succession and part non-family. And what we did here was we actually adopted slightly different strategies for the two parts. So for the father who wishes to pass shares to his son, because it was a trading business, and he didn't want any consideration, he didn't want to get any money for this, he was quite happy just to give some shares to his son. And indeed that's what he did. Because it's a trading business, although it's deemed to take place at market value for tax purposes, he was able to claim capital gains tax holdover relief, so we had no upfront capital gains tax. For inheritance tax purposes, as we've said, we would potentially need to think about inheritance tax if the father were to die within 7 years of making that gift. But this is a trading company. It does qualify for business property relief, and therefore, provided the son retains those shares, whether or not the company itself qualifies for BPR in the future, if he were to die within 7 years, then we're not going to have any inheritance tax that's going to be payable. I've mentioned also the employment-related securities legislation. It's important to remember that the son is also an employee of that company, and he is receiving shares at an undervalue, and therefore the employment-related securities legislation could subject that undervalue to income tax. However, there's a family exemption from the legislation for employment-related securities that we could claim and apply in these circumstances. So essentially, we achieved our family succession by a simple gift of shares, no upfront or adverse tax consequences to that, all very neat and tidy. For the non-family member, the situation was a little bit different, because the other shareholder who wished to exit and realise, did wish to actually realise some value for his shares. So what we did in that circumstance was we actually set up an enterprise management share option scheme, so that the other person they wish to bring into the business could be granted options to acquire shares, and those options were over shares that were held by the other main shareholder who wished to exit. This carries a number of advantages. Firstly, it's a tax advantage share option scheme. So for meaning that there's a number of tax advantages effectively for the option holder in relation to entrepreneurs relief and things further down the line. We were able to agree a share value with the revenue up front, which you can do for EMI schemes, and that's with the benefit of a minority interest discount. So whilst the whole business as a whole, say, might have been valued at say £1 million, and that could be £100 per share, say, because he was only going to be acquiring, I think in this circumstance, it was certainly less than 25%. We were able to discount that £100 per share down to something much more acceptable, which to the purchaser effectively. So the the minority interest discount in those sorts of circumstances, it's not uncommon for that to be sort of 60 or 70%. This made it affordable to the incoming shareholder, but also the exiting shareholder was happy to accept that fairly reduced value for his shares. And then effectively we put in place a bonus structure to allow the option holder to acquire those shares over a period of time. Case study 2 is quite different. So here we have another family-owned company, largely owned by mum and dad. Their 2 sons did already have some shareholding in the business, but mum and dad are essentially retired, and they'd like to pass the rest of the shares really to their 2 sons, who now run the business and have done for a number of years. As we've just shown on the previous example, if this were a trading company, it would be a very straightforward situation that we could effectively just gift those shares, claim holdover relief, and it would all be quite straightforward. The issue with this particular business was whether actually it is a trading company or not. It does a variety of different things, but had property investments, undertook storage activities from some of those property investments, and there's significant concern that actually HMRC wouldn't view this as a trading business, and therefore we effectively couldn't get the CGT holdover relief that we wanted, and we'd also have IHT issues that we'd have to think about more seriously if mum and dad were to die within 7 years of making that gift. Now, it's possible to go to the revenue and to ask for their confirmation as to whether they consider that a company is a trading business for the purpose of business property IHT relief. And we could have done that up front, but as I said, there was a significant risk really that if business property relief was available, it certainly wasn't going to be available in full. And whilst mum and dad are in their 80s, in this particular case, the sons and indeed the family, mum and dad, were happy to wait a little bit longer, and they had a number of areas of the business that they kind of wished to change, which were much more trading related. So in this particular scenario, and it's an ongoing situation, the directors, the sons, have kind of changed the nature of that business over the last 2 to 3 years, such that we now feel much more confident that it will sit the right side of the line of being a trading business, which opens up the more simple sort of succession route. So the next stage in this particular case study is that we will be going to the revenue, and we will hope to get confirmation that the business now qualifies for business property relief from IHT, and that should give us the comfort really to go forward with a fairly straightforward succession strategy. If for any reason that doesn't work, then we've got other options that we can look at. So I mentioned previously the use of a discretionary trust. The values are such that we may not be able to put too much into the discretionary trust, but it's certain without creating an upfront inheritance tax liability, but that would allow us to transfer some value into a trust, which could then be applied for the benefit of the sons. Another option we might consider is the use of growth shares. So we would essentially be looking to lock in the value that has accumulated to date in that company within the existing share class, and then to create a new class of shares that will be held by the son, into which any future value will flow. So that's another strategy we might consider, and in the right circumstances can be very valuable. Of course, the third option that we might consider is actually the parents, given that they are in their 80s, holding the shares until the death at least of the first spouse, and using an interspousal transfer effectively, coupled with which is exempt from inheritance tax, and coupled with the CGT uplift to then transfer the shares to the sons following the death of mum or dad. So that's all I'm going to say about family businesses. Just conscious of time, but I think we're broadly okay. Moving on then to employee ownership trusts. As I mentioned at the outset, this is a new tax regime, actually introduced back in 2014 now, which is a bit scary for me. It means time's flying by. And it applies to certain disposals to employee ownership trusts. And it can be an attractive option, although I have to say it's not one that we've used extensively in practice, where perhaps a sale to a third party is not deemed desirable, or indeed actually a third party purchaser can't be found. And what it allows the selling shareholder to do is to realise some of their value, and essentially it's deemed to happen at no gain, no loss. So therefore they can actually realise a capital gains tax-free disposal. Given that generous tax break, it's not surprising that there's criteria that's attached to that, many of them, and I'm not going to go through all of those now, but just focus on a few headlines of how the structure works. So essentially there has to be a sale of the shares to an employee ownership trust, and that sale has to be of a controlling interest, i.e. the seller must be giving up control of the business, so it has to be more than 50%. The company must be a trading company or the holding company of a trading group at the time of disposal, and indeed for the rest of the tax year in which that disposal takes place. And the employee ownership trust itself must meet a number of criteria, but essentially it has to be set up to benefit all employees potentially, and there are tax reliefs that are attached to this structure for the employees as well. I won't get into the detail of that, but the principle is that we are doing something that should be for the future benefit of all the employees. It's a one-off relief, and that means you only get one shot at it. So if it's claimed, you can only do it in one tax year, and you have to also take into account persons connected with you and things. And as you'd expect, there are a number of clawback provisions which can apply broadly if there's a disqualifying event in the following tax year, i.e. the tax year after the disposal, one of which, for example, would be ceasing to trade. There's also certain IHT relaxations which allow the funding of the employee ownership trust by the company, and so that's one mechanism of effectively getting cash into the employee ownership trust to benefit the shareholder who's selling. But all the restrictions and the anti-avoidance provisions on this are basically designed to ensure that the selling shareholder does transfer to the employee ownership trust a viable company, i.e. a viable company is left behind, and it's not sort of so laden with debt that it's very quickly going to fall over. So in the right circumstances, then an employee ownership trust or disposal to an employee ownership trust can be a valuable tool in succession planning. The final subject then was just to look briefly at cessation and an orderly winding up. So, why might this happen? Well, as I mentioned at the outset, it's possible that, say, a business is sold its trade and assets, and you then want to extract the proceeds. So if you've got a company, it might sell its trade and assets rather than a sale of the shares, and you're then left with a pot of cash and you need to get that money out. It could simply be that a business has reached its natural conclusion and it needs to be wound up in an orderly manner and its assets distributed. I've recently been working with a property development company that has kind of come to a natural end. It's very much a family business, but there's no succession or viable succession within the family, and therefore a decision is being taken really just to wind it all up in an orderly manner and then to distribute the assets. So where you've got a company, liquidation under either of those circumstances that we've talked about will often be preferable. And the reason for that is because if you undertake a formal liquidation, you're into capital treatment. In other words, capital gains tax, potentially with the benefit of entrepreneurs relief, and not income tax at dividend rates, the maximum dividend income tax rate currently being 38.1%. The one exception to that really is if you've got quite a small business where the assets are less than £25,000, then there's no need normally to go through a formal liquidation process, and you can extract up to £25,000 worth of value under the capital gains tax regime without a risk of income tax applying. So just because you go down either of these routes doesn't mean you can't qualify for entrepreneurs relief. the rules are quite generous, and basically these stipulate that where a company sells its trade, it ceases to trade, and it's then wound up and cash is distributed to the shareholders within 3 years, it's still capable of qualifying for entrepreneurs relief by reference to a qualifying period in the prior to when the company ceases to trade. As I mentioned, there's potential double charge to tax because if you have a company that sells its trade and assets, the company may pay corporation tax on its capital gains on the disposal of those assets. The current rate of corporation tax costs 19%. So you suffer tax at the company level, and then there's further income tax that's suffered when that's extracted. There are strategies to mitigate that, and one of the things that can be looked at is if you've got a purchaser but they don't want to acquire your existing company for whatever reason, perhaps because there's concern over legacy liabilities, recognised and unrecognised, that might be in that business, then you might look at a pre-sale hive down of the trade and assets that the purchaser wishes to acquire, and then sell the shares in a subsidiary company. Following certain sort of relaxation and changes in provisions, it's quite often now possible, it's potentially possible and often possible to structure that in such a way that the double layer of tax is avoided through the use of the substantial shareholding exemption for the company. One of the important things to watch in any cessation type arrangement is a relatively new targeted anti-avoidance rule, a TAR, that was introduced in April 2016. This is aimed really at anti-phoenixing. So the government were concerned really that people were shutting companies down in particular, claiming entrepreneurs relief, paying just 10% rate of tax on effectively accumulated profits of that business, which they'd never taken out and had subject to income tax. And then almost the next day setting up a new company to go and do the same thing again, and just to keep going in that manner. So the targeted anti-avoidance rule basically says that if within a 2-year period following the date of a distribution during a liquidation, for example, you're involved in the same or similar activities, then this TAR can apply, and it's an extension of the transaction and securities rules. And the government, the revenue, if they invoke it, can look to charge that distribution to income tax at dividend rates and not capital gains tax. So it's always necessary to be mindful really of this TAR and to think about what the shareholders are going to do post liquidation. I mean, clearly if they genuinely are retiring, it's not a big issue, and indeed, if they're going to go on and do something that's similar but different, and you can be comfortable that perhaps because it involves different individuals, that tax avoidance is not one of the main motives, that there are certain get-out clauses from the TAR. That pretty much brings me to the end. I just had one final question that I was going to ask, which is really whether any of you listening out there have already taken tax advice on your business succession needs. So if I could please ask you just to vote a yes or a no, that would be great. We'll just leave it a moment for those to come in. Looking at the votes cast, we actually seem to have a significant majority of people saying they haven't already taken specific advice on their succession needs. And I guess given that most of you at the outset, or about half of you at the outset, said that it was more than 3 years away, that's perhaps not unsurprising. But as I said, one of the main points I really wanted to get across today is the importance of planning ahead. So really, just to sum up briefly, this webinar really only scratches the surface of some quite large topics and some of the tax highlights. Often we do see a number of viable options, but no two situations are ever the same. Planning ahead is very much key to avoid nasty surprises, but also because significant opportunities may exist to improve the tax position by perhaps slightly restructuring a business. So please do get in touch if you want to discuss any of your succession planning needs. And then just a reminder really that this is a webinar of a general nature, and specific advice is strongly recommended. I've certainly run out of time, so I won't take any answer any questions, but I will follow up with those of you who have raised questions individually. Thank you for listening. Goodbye.